Hey Gengar Gang, what is going on? My name is Ryan, this is the Analytic Gengar, and welcome to another video. In today's video, friends, we talk about the big implications to the stimulus bill that was just passed here in the United States and why it might have a major impact on not only the US economy, but the way that Pokemon sellers operate in the future. Now, it should be noted that today's video won't focus on where, stimulus payments are going. If I'm being very frank, I think many of us are probably in a better position than we were a year ago when other stimulus payments were given out. And so I think for the most part, that income will probably or likely be treated more disposably than previous stimulus payments have been treated. If my theory is true, that means we should be seeing a pretty significant injection of money into the hobby, especially at the lower levels. So things like Shining Fates, things like Battle Styles, I have a feeling will spike in value a little bit. And, that vintage stuff that has that $1,000 price range will probably see a lot of business and volume over the next couple of weeks. But this video is actually in regards to some reporting changes that have been passed into law that were attached to the stimulus bill. So without further ado, let's get into it. Now, this article is written by Charlie and is an article found on runningwithmiles.boardingarea.com. I'll have a link down below so that you can check it out. And basically, the summary of the article is that if you use PayPal to receive goods and services like eBay transaction, Facebook Marketplace, etc., you'll find some new changes to the way that your income is reported to the IRS because of the just passed stimulus bill. Now, a lot of people may say, wait, Ryan, if it's a stimulus bill, why are there laws or changes about tax forms in that particular bill? Well, to answer the question very, very simply, and realizing that I'm not a political science person in the slightest or a government and politics person in the slightest, it's basically called a rider bill. So effectively, when Congress wants to pass large laws, they may also attach little side bills that also get passed into law. And effectively, it rides its way through the legislative process by being attached to these larger bills. So by and far, the stimulus bill was going to get passed one way or the other, and so they just attached this provision about third-party networks reporting tax income as a rider bill to the larger stimulus bill. Now, let's start at the very, very basics here. Whenever you get income reported from a third party, it's typically reported on something called a 1099-K. Basically, it's a form that gets sent to the IRS and it says, hey, this is how much money we've processed for this person. And the IRS gets a copy of that, and you get a copy of that. And in theory, you should be matching what's on the 1099-K with what gets reflected on your tax return for the year. Now, in the past, mandatory reporting and issuance of a Form 1099-K was required if you had two conditions met: $20,000 worth of payments and more than $200 individual payments. So be very careful about the way that you understand this. It is required of a third party to issue a 1099 and report the income to the IRS if you meet both of these requirements. So if you had one $20,000 transaction, technically they're not required to issue a 1099-K. You would have had to have 200 transactions of, let's just say, $1,000. That would be $200,000. But because it beats most of these criteria, you would find yourself having that income reported to the IRS, and it would then, of course, be necessary for you to use that 1099-K to report that income on your individual tax return. I'll also bear in mind that although this is the legal requirement, individual companies may have set more arbitrary, lesser requirements for themselves. So, just as an example, PayPal might have said, okay, if we do more than $20,000 in transactions, we're issuing you a 1099-K. We don't care. it doesn't matter if it was one transaction, 50 transactions, or 200,000 transactions. The minute you hit 200,000, you're getting a 1099K. A lot of companies do this because it's probably just a better way of doing business and staying out of trouble with the IRS and the US government. So very simply speaking, they could issue 1099Ks whenever they wanted to, but you were required to do that if these two conditions were met. Now, the major change that has come is that for third-party platforms such as PayPal, Etsy, eBay, etc., any of the various third-party websites that process payments, including things probably like Venmo or Cash App, and all other third-party platforms, is that you now have to report, meaning you're going to get reported to the IRS if you have income for transactions that exceed $600 for that year. So, what this means effectively is that if you have goods and services transactions that exceed a total of $600, doesn't matter to the number, as long as the total payments processed is over $600, you're going to be issued a 1099K. So, this is set to kick off January 1st, 2022, meaning we still have all of 2021 with the previous version being 20,200 individual payments. Starting next year, as soon as you hit that $600 total number, you're going to be issued a 1099K. So, where does that put us in the grand scheme of things? Well, a couple of different thoughts. One, it's a pretty drastic drop. As you can see, unless you were doing high dollar amount transactions, you really probably weren't going to get a 1099K anyway, meaning the IRS wasn't going to have that income reported to it by, PayPal or eBay or whoever have you. Dropping that all the way down to 600 with no threshold on the number of transactions means basically everyone who buys and sells with even relative frequency is probably going to be issued a 1099K. The other thing to bear in mind here is that for the fair majority of people, this probably isn't that big a deal. Because if you're in a situation where you were being issued 1099Ks in the past, meaning, you were hitting this $20,000 threshold, chances are you're big enough a seller and buyer that you're not willing to risk issues with the IRS and other tax authorities in order to save on a couple dollars worth of tax. Put differently, these are probably going to be the big guys in the industry, the big guys in the hobby that, they do this stuff as a legitimate business, and so everything is on the books and above the table anyway. Realistically, a lot of the sort of hullabaloo about this is directly related to two types of people. The first are people who kind of skirt the minimum requirement for reporting to the IRS. They don't sell $20,000, but who knows, they might sell like $5,000 a year. It's a decent side hustle for them, right? For individuals like this, they're obviously now going to hit that $600 minimum requirement for reporting, and so they're going to get reported, and it's going to have an implication on their taxes, because they're now going to, let's just say, have a 25% tax imposed on the $5,000 in profit that they made for the year, meaning they're going to owe an additional $1,250 at the end of the year. And unless they keep the money to pay it at the end of the year, they will have a pretty large payable due right around tax season, which can impact their liquidity. Now, a bunch of folks have gone to say that situations like this may play out for, people who are smaller and therefore, don't always have the means and the necessary components within their quote-unquote business to track, the taxable income that they have and report it to the IRS. So they're going to have to learn how to do that. And of course, whenever there is an additional compliance requirement, there's always an additional cost associated with that. So that means people may need to start using things like QuickBooks or keeping an Excel sheet and really kind of backing up and substantiating every single one of these different transactions that they have with some legitimate, receipt or transaction history. The other type of individual that this is going to directly impact are what I'm starting to call the tax clowns. So these are folks that, the minute like a conversation comes up on Facebook or a discussion thread, they immediately jump to the often funny conclusion that, tax is theft, and, they basically make light of the situation. And I call them clowns not because of their opinions, but because their willful ignorance towards the topic is probably why it's going to have a huge impact on the hobby. Because these are individuals who either never reported anything to the IRS, never filed anything on their taxes, and now they're going to turn around and say, wait, what? I got a 1099-K. The other thing is that it's very funny, because if the IRS is having this stuff reported to them, and then on the back end, they have no clue because they shy away from every conversation regarding taxes ever, then there is a potential that a lot of these folks are going to get audited and potentially have those taxes assessed, as well as, have a lot of time spent sort of dealing with the audit itself. So ironically enough, it may be a huge detriment for folks like that. And that's why a lot of people are kind of concerned, because the idea here is that this additional new reporting requirement is going to put a lot of tax burdens on a lot of individuals who previously may not have had those tax burdens. Now, this should go without saying, but if you're in the US and you operate and you make a profit, technically you should have been reporting all of that regardless of whether or not you get a 1099. The idea is that you should be keeping track of your basis, you should be keeping track of how much gain you got, and then you should be reporting that as either long-term or short-term, depending on the length of time you held that particular collectible for. The ironic part is that obviously in reality, let's be real here, a lot of people probably don't report it, or they report only some component of it and leave another component off to the wayside. Or they report only the stuff that's been reported to the IRS and they keep the other stuff off the books. So for a lot of individuals, that lower threshold means they're going to be a lot more taxes assessed, and in theory, it may be to the detriment of the Pokemon community at large. So what are my long-term predictions for something like this? Well, there's a couple of things. One, like I said, people who choose to actively shy away and remain willfully ignorant of tax law and how it impacts our hobby will probably find themselves in some pretty rough spots come 2022 and 2023, particularly when they have to file taxes for the calendar year 2022. The other major thing is that for the smaller sellers who, would have otherwise conveniently left that off their taxes, they're now going to be forced to report a lot more income than they have in previous years. And unless they have a pretty legitimate job that, they can up the contributions for, they're going to realistically need to keep some part of that money in the bank account to pay taxes at the end of the year. The way I'm thinking about it, come 2023 April, you're going to see a lot of people struggling with liquidity. And the reason for that is because instead of having, $5,000 to drop on a booster box, that's how much taxes is going to be owed to the IRS. And that may impact the hobby right around that time. So I would say early 2023 is a time to watch, because it might be a good time to have a lot of money to buy stuff and not a really great time to be selling things, because there may be a shortage of funds in the community by and far. The other thing is that for the bigger folks, your brick and mortar stores, your very popular online sellers, probably your big YouTube guys who sell stuff as well, I don't really see big changes coming. They've probably been reporting this stuff for as long as they have been. And so the new requirement obviously lowers the threshold, but it's not really going to impact them because, frankly, they're not going to really care much. At the end of the day, they've been reporting this stuff. They are a legitimate business. They see, they treat it as such. It's not a side hustle for them. And so it's probably very likely that these individuals have been doing this for so long that they'd rather just faithfully report the income anyway and avoid tax issues, rather than being in a situation where, they get caught up in an audit and then they have additional penalties assessed on them. So for the bigger sellers, I really don't see much changing other than perhaps one or two individuals, but when it comes to those medium sellers, and the folks that are willfully ignorant of tax law, I think you're going to see the biggest issues with those individuals. And unfortunately, I think that the demographics of the Pokemon TCG hobby right now are very largely filled with those smaller sellers that work a side hustle, and those other individuals like the folks who just actively choose to be ignorant of the tax law. The other thing is that the one other key component to understand here is that this has some major implications for the use of PayPal and other parties. Here's the thing. The main gimmick here is that your payments need to be flagged as goods and services, which means if you use friends and family, you technically skirt around this requirement. However, PayPal has gotten very aggressive recently about tracking and monitoring friends and family payments. So if you're just sending out of the blue to someone you never have before, and you're sending them $4,000 or $5,000, they may call it a goods and services payment anyway. So I'm really interested to see how that's going to play out. The other thing is that, you may think if you just run to Targets every Friday, buy a couple products and flip them on Facebook, that you skirt around this issue. But here's the thing. As long as there is a payment intermediary, a PayPal, Facebook payments, anything of that nature, that's where they're going to get you. That's where the requirement is. It's not on you as an individual, but rather on these third-party networks to report on your behalf. So even though you're just doing this at your local Target or Walmart or whatever have you, as long as you're using a third party to settle payments, and it's not something like Cash App, Venmo, or QuickPay, and it's one of these services like PayPal where you can flag something as goods and services, the requirement applies and you will have that income reported. So just bear that in mind. A lot of people might be quick to think, their local flipping scheme is safe from this, but as long as there's a third party involved, the reporting requirement will remain in place. But with all that said, friends, thanks again for checking out today's video. I do hope that you found it insightful, and I do hope that you can at least consider this as you decide whether or not you want to sell in the future, and more specifically, how you would like to sell. Bear in mind that I'm not a financial or tax professional when it comes to this video. I'm just sort of reporting the facts as I've interpreted them and providing my opinion on it. So obviously, if you have any questions about this and how it will impact your individual taxes, I definitely don't recommend putting that out there as a question down below. If it's sensitive financial information, it's probably best to discuss that with your accountant or a tax professional that you're working with. So that's also something very big to consider. Other than that, today I will be hopefully a lot quicker to answer any comments down below. So if there are any generic questions, feel free to ask those down below. And other than that, I hope you guys are having an amazing Saturday. Thanks again for checking out another video, and we will talk soon.